Hey everyone, we're with Markets and Mayhem. One of my good buddies. We like to chat on markets a lot, man. It's been we catching up the last couple of weeks on what's been going on in the markets. I thought we've had some really great conversations. I wanted to bring them over to my channel as well, so everybody else can kind of hear what we've been talking about, what we've been looking at, how we're doing it, and it's always a blast to have him on. He's also running a macrovisor right now. He's been trading since 2005. How are you doing today, man? It's great to catch up with you once again.
Hey, Jason, happy Monday. It's great to be with you too, my friend. I really enjoy our conversations. And like you said, we've been catching up, talking markets. And, it's always been a pleasure to talk with you. I remember when we met, several years back, and it was really just on comparing notes and feeling like we were two of the voices out there that were voices of reason in a sea of noise. And so it's really built from there. And I'm doing well, my friend. I had a good weekend. How about you?
Oh, wonderful. Just had some good times. There's a BMX contest in Cleveland. Got to see some old friends, so that's always fun. And back to the markets on Sunday night because I'm a futures guy. And start the week off right, man. It's a interesting way to start the weekend as well, or start Sunday as well, watching oil kind of just explode over the weekend on just a tiny bit of news. One of your analysts I did see talking about that early, so good job on that as well.
Thank you, my friend. That was a really interesting one because one of the things we saw going into that, well, there was a convergence of different factors. There was extreme bearishness, both in skew and short positioning in the oil market, right? You had this macro factor in the sense that there's not a lot of supply. So if demand starts to come up or supply starts to shrink, there's a lot of upward catalyst. We've gotten down into the mid 60s, and there's a lot of OPEC economies that just they can't deal with that. They have to have oil 70, $75 a barrel. My
Mm.
partner Aisha's talked about this a lot as well, where if you're not basically at 75, you're not able to run your budget in Saudi or in UAE or in Qatar. And so it was interesting to see that announcement because what it really did, and I think these guys are pretty savvy. They saw this short positioning and they're like, you know what we can do to make some money on our, you know, we can just blow these guys up. And they did.
Well, it's funny because you kind of I've been seeing it a lot lately where people talk about the CTA positioning, and like they're a lot of the times they can be on the wrong side of things or the right side of things. They're the people who are going to trade something, like we talked about bonds the other week. When bond yields are going negative and everybody's going they can't go negative. They're the ones who are going to be able to hold on to those positions. But at the same time, there's times where you get chopped up to death in the wrong market environment.
Yeah.
And that's the thing about all trading and all strategies. There's times where things, I don't know how many people have been following me on here for and how long people have, but if you know my trading style and you have been following me for a while, there's 15 different strategies on a sheet that I run all the time, and that could be all the way from macro fundamental, all the way down to systematic technical. And for me, why I do that is because I know there's many different environments for the market, and I know not everything's going to work all the time. So when these people kind of get all on, and most of the time, I'm always looking at how on one side of a trader they are and what is the trend. If we're in a very trendy market that's trending just straight up all the time, it's not going to bother me as much when there's so many longs on the side of things. If we're in a very choppy market and we start to see very, very significant bearish positioning, like we saw in oil, like we saw, we've seen that in the November election in 2020 in the S&P. When we start to see those types of things, we can kind of put it together and go, oh, this is a choppy market. Moves can be very, very false very quickly because you got to think a lot of the CTAs, their programs are going to be, 100-day lows or new lows or something. So when you see these new lows, like came into oil, see a new low come in, it reverses quickly. For me, that's one of my favorite signals to buy. Basically, you call a fake out signal, you call it the oops signal. There's a million different people call it a million different things. To me, it's just you got this false breakdown, it reverses higher, and we kind of take off from there. And so I could see this being a very significant move in oil. I feel like that was what also, if I remember right, which I think I am, there was a very similar signal in 2020 that started that oil run all the way past 100. So it's going to be very, very interesting to see what goes in the market. But I totally agree. It's very interesting to kind of see that type of signal come in once again.
It is, and it's interesting because this is one of those signals where you see a convergence of the macro element of what's happening, which is, China's coming back online. They're starting to use more energy again. There's some degree of normalization of their economy. And we're in this bizarre world where credit cycles are no longer synced, right? We had for so long central bank policy kind of harmonized, which created a harmonized credit cycle. We're not in that environment anymore. China's central bank ended their credit cycle in early 2021, bringing about a recession and a brutal bear market in Chinese stocks. Now they're on the other side of that. They're actually easing into the current environment. They're starting their new credit cycle as we're ending ours here. And it creates a bit of an offset for the economic weakness that we have and that we're sort of exporting, that the world's second biggest economy with the largest amount of middle class, over 700 million, are coming back online with an expansion of credit, that China credit impulse coming up, economic activity increasing. And while it hasn't been the strength of the reopening that maybe some people thought it would be, it's still strong enough that it's putting a floor under oil on the demand side. And then over the weekend, we kind of got a sense that, there's people on the supply side that are thinking if oil gets much weaker, we're just going to cut off the spigot more and more and more so that we can support our economies. And I think all of that put together paints a macro picture that's bullish for oil. And I love what you talked about, this head fake, right? When you get a head fake, particularly in a market that is so aggressively short like this, it's logical that people are going to pile on. You're making new lows. You've got this momentum. But at the same time, there's a lot of risk in that because of the concentration of positioning. And so when you have this kind of reversal, like we just saw really since March 24th, but especially overnight, that catches a lot of folks off guard. I can't imagine how many people were like panic covering into the illiquid futures trading last night.
Yes, and that's exactly where we're at. We're seeing, and you brought up a good point about, the global economy. Like a lot of people are going, well, the world's going into recession. Well, it's like, well, a lot of the world was already in recession.
Yeah.
So if we're looking at it from that lens and going, okay, well, how much worse can that get on the demand side? How much worse can that get on the supply side? If you just kind of put these things together, you see that certain things can't go much lower. Like once again, the Fed has to do what it's doing. If the Fed actually is pulling back, which that's what the market's thinking right now, and it doesn't matter whether that's right or wrong, it's it's the thinking right now. You add that with the short positioning, you add that with all this, the oil rally could go a little bit longer, and honestly, a lot of the commodities are perking up a lot as well. So if we're looking at, it as in the big macro picture and going, okay, this is what we're seeing. We're seeing that there is and most of the time the commodities are a demand-based market. Like all commodities are demand-based as it comes to price. Yes, there's a supply side issue. Yes, you have to kick supply and demand, but most of the time, if demand is rising, you're going to see a rise in price over if supply is tightening. I don't know why that is. It's just what it is. But yeah, if we look at oil, yeah, I was right. So I did remember correctly. That was a false breakdown signal that started that rally from the signal would have came in around 36, all the way to, that was the $130. That was a massive rally, and
Wow.
these things come in like crazy. And those false breakdown signals happen a lot. Add another thing into it, which is something as simple as a 200-week moving average that came into it. That doesn't mean that moving averages are magical. I don't believe that. I don't think that's the case. But what I do think is that even though a lot of people say they're not chartist, and even though a lot of people are fundamental based, everybody wants to buy at a good level. Everybody has a 200-day moving average on most of their charts. I don't care if you're institution or whatnot, most people do. So seeing came into that level, all these things kind of came up, not to mention the SPR, like all these things, just add them
Oh
all
yeah.
in there. and boom, you have a nice little reversal. And I think, if we, can get over that level of, 85, this thing could continue, and there's no real telling when things can stop. But once again, there's going to be lots of little movements inside of the movements. The trade we were talking about earlier, from that 35 to 130, there was plenty of pullbacks in there. Of
Oh
oil
yeah.
is a very volatile product. That was we're even looking at I'm looking at a 30% pullback in the middle of all that. So I mean,
Wow.
it's a very volatile product. So, no, don't say it's going to go straight up every day. That's for sure.
That's really interesting that you mentioned that too. And I think that's an important point, because when we were talking last time, one of the things you had said is, in some of my systematic trading models, you've got to have a stop that maybe is wider than 30% to be able to capture the move. And of course, then one looks at how will I size my position so that I can take a 30% drawdown and keep going, or maybe even add into that if I still feel like the overall trade is intact. And that's such an important point, because a lot of folks might look at this and say, well, then maybe I should just pile into my long and just, kind of ride the way up. But this is a really volatile product, which means that, for the way I trade it, it means I'm going to get in. If I'm not day trading, if I'm swing trading it, I'm going to get in chunks, right?
Mhm.
Maybe thirds or quarters to build that position up. And I'll be opportunistically taking advantage of weakness as long as I feel like the overall trade is still intact. So if we have that outlook, if we say, look, we know this product is incredibly volatile, like you said,
Mhm.
then we can position ourselves for that and have dry powder on the sidelines for those inevitable pullbacks, just like we can take a little bit off when it has this sort of irrational strength into key areas of resistance and starts to get rejected lower. There's so many ways to take advantage of that volatility. And I think that's kind of a theme of the last several years, taking advantage of volatility.
Yes. And that's a great point. And we talk about this all the time, which is the fact that it's always about having that stop loss that's wide enough, being able to use your actual sell signals to sell instead of your stop loss. So once again, certain products are going to have 30%, 35%, Bitcoin's at 35%. All these things are important. And it's not that if it got stopped, I'd be miserable. It's like, okay, if let's say I got stopped out, went to the 130. When was it 30% down from 130? It came in, it was, around, I should have been able to do that math off the top of my head, but we're just under 100. And so if we're looking at that situation and going, okay, I caught it at 30 something, I got out around 100. That's a great trade. You're never going to catch it perfectly at the top. How many people were going, the Russian situation happened right at the top. That's February 28th, or early March, in 2022. So if we're looking at that and going, okay, well, this situation's happened, I'm going to get out perfectly, you wouldn't have known. Like, you could have easily created a thesis saying that, now that the Russian crisis has happened, oil, they will fight the world forever, and they're tight with Saudi, so they're going to tighten the supply, and oil's going to 500. Like
Yeah.
you could make up anything you want to in your head if you want to create a bearish thesis or a bullish thesis. But if you just go, okay, look, like my sell signal is going to come in at this point, or blank, I got stopped out, just get out. And honestly, that was a very solid trade. You get your next oops signal, or false breakdown signal, whatever you want to call it, and maybe you're off to the races again. But either way, you're always have to think about protecting your ass. And two ways of doing that is having small position sizing. It's incredibly important, and always running a stop.
Yeah.
If you are moving this 30% range, and one trade is 30%, absolutely do not put your entire portfolio into that, because one trade will wipe you out 30%.
Yeah.
But if you have, a very small percentage of your portfolio in that, let's say 10%, even though that's still, I wouldn't suggest that for anything like oil, but let's say you do have 10%, now you're losing 3% instead of 30%. And it's the same way with what I would really try to do is use more like 5% of my portfolio. That way, if it does get stopped out, I'm getting stopped out, and I'm only losing about 1% of my portfolio.
Yeah. Yeah, that's important. And I really like what you're talking about with these head fakes, because in this environment where we do have overall lower liquidity, so higher volatility, there's more room for overreaction. And when there's overreaction, you get trapped off sides when the market reverses. So in this case, when oil's gapping down and everyone's talking about it's going to negative infinity and we're all going to die, you know, we get a lot of people that get real excited, they get real short, and then as that price reverses above the price that they shorted or wherever they're placing their risk management, then you get this forced buying. And then you have momentum buyers coming in on top of that, and that can really help to amplify that trade. So those head fake signals, for people out there that are listening, if you're not familiar with trading that, it's like Jason said, he makes a really good point, because that's one of the most powerful signals there are, because you got to think about it. You got one side that's really, really aggressively, shorting the heck out of this thing. That's usually what you're going to see in something like this, particularly when it works really well. And then you've got the other side that either are not participating or it's just very light. So long exposure in crude, if you look at it through a number of different optics, has been pretty depressed over the last several weeks, right? And so what happens is all of a sudden that scale goes from heavy short, light long to heavy long, light short, and you get this violent reversal in price, and now oil is up like $15 from its lows since March 24th or so, which is, it's incredible. And it's
You
this
know,
sort of stuff that we can map out as swing traders as opportunities. And the point you made about sizing, I love that. If this thing is going to move potentially 30% against you, why would you want to have more than like 4 or 5% of your portfolio in it, right? Because it could wipe out so much capital if you are wrong. So there's no reason to marry ourselves to a trade or get completely concentrated in a trade. The idea is to have positions that if you're wrong, oh well, you got plenty of capital for the next trade. If you're right, you make some money, you close out your trade. And quite frankly, for most people, it's easier to close out a trade if you don't have so much money riding on it. If it's just a smaller position and you don't have some kind of emotional attachment to it, you just say, okay, got my signal, or I'm at my risk management point, I'm out, on to the next opportunity.
yes, and that's the truth. It's incredible to think that, and I think that's the biggest thing that's a problem with all traders. I'm not just talking about people who are just starting, like anybody in general. People can get easily wed to your positions have done so well or your positions have done so badly. Like I know that even myself, like I'm very hard on myself. I try to work extremely hard and do what I can do, but sometimes the market isn't made for me. Like the market is never made for me. So because of that, I have to be better about recognizing what environments are good for me, like so I can give myself a break, like, hey, this isn't my environment, like I don't really like this type of environment, so maybe I'll trade smaller or not trade at all, whatever that is. If that's you, just not making a suggestion for even what I do, but for you, that's an idea. Like for anybody who's listening, you go, okay, well, I don't like this environment, I don't trade this way or something, and this way you can kind of give yourself a bit of a break, because it's very easy to get very into your emotions, and it's very hard to journal your emotions on trading every day. Like I like to give myself a list, like, am I in a good mood today, am I in a bad mood today, like, because when I'm putting on a position, that could be something that has something to do with that. I could be upset and be more bearish, I could be too happy and be too bullish. Like it's something that you really have to think about, because our emotions really are tied into trading more than anything else.
Yeah, that's a really good point too. And one of the reasons I use a robot avatar on Twitter is that you really do need to trade like a robot, removing emotion and bias for the purposes of trading, whether it's a short, intermediate, or even longer term time horizon. It's very, very important. There's nothing wrong with doing analysis, understanding what the big picture is, and putting those pieces together so you have some sense as to where things are going over the long term. But you can't really color your trading and your investing solely off of that, or even primarily off of that. It's like a checkbox that you have in a group of different checkboxes, and one of them, quite frankly, is positioning, another is sentiment, another is technicals, another, as applicable to the asset class, is fundamentals, and then there's the macro picture. And I love to see convergence. That helps me to remove bias as well. If we see a bunch of these check boxes that we can check, but for the short to intermediate term stuff, macro is big picture. It takes a long time to play out. And same with fundamentals, quite frankly. The market can stay irrational longer than we can stay solvent, as Keynes said, and it's true. And so for some of these opportunities, it's really important to let the analysis of some of the more mathematical components as it concerns the product itself, how it's trading, how people are positioned, to get a better sense. So for the oil trade, like we talked about, the macro picture painted one of, yeah, there's some potential for upside here, but there's no need to rush in. And then the discipline of being a trader told us that let's wait for that entry signal, right? Like someone who's just waiting for that exact right moment to take that opportunity, sort of like a sniper waits for that exact right moment to get the kill shot. That's how we have to be a successful trader. You're waiting for everything to line up. And the biggest thing, and this goes to everyone out there listening, maybe you've dealt with this, maybe you're dealing with it now, maybe you've come up with a way that can help others, and you could share that in the comments. But the biggest thing is to make sure that when you're trading these, you're not just getting in and out of positions for the sake of trading. You're doing it because your system creates a signal that gives you the confidence to not only get in the trade, but to know that it's a valid trade, to know where your risk and reward is, and your reward has to be asymmetrically higher than your risk to make it worth it. We're not here to gamble if we want to be consistent and successful. And most of the time, you're waiting for that signal. You're not just putting on one trade after another. I know there's a lot of sort of, making this more glamorous and more like a casino, and everyone's always printing money every 5 minutes, enough to retire. But the reality is that, these are things that we lie in wait. Like you and I, when we're waiting for a swing trade signal to fire off, we're content to do other things. We're not sitting there watching every tick. We're going and we're doing research. We're maybe building another model. We're back testing. We're doing things to continue to improve our skill set. And when that signal fires off, we check it against maybe some different things, and we say, okay, this looks good, I'm in. And I think that's really important, because to be successful in this game over the long term, because everyone can get lucky in the short term, and that luck can actually go against you in a big way. But in the long term, it's about understanding how you trade. And Jason, you told me this like 2 years ago, and I thought this was a really, really good lesson. Some of your first trades, you made all this money, and you talked to a friend, and they're like, but do you understand how it works? And you're like, no. And so, he was like, well, then how do you do that consistently? And that's the big thing. Like, if we don't understand why our trades are working, we should take a moment, count our blessings, and then try to figure out what's going on.
Yes, and they always say it, the worst thing that can happen to a trader early in trading is that they make money. And it's true, like that's the thing. Like everybody who's taught me anything about trading has always said that. As the same way as like, you always have those kids who will come up to you like on in Twitter land or in real life or wherever, and they're like, I did this and it killed it, and you're like, how did you do that? Well, I listened to Elon Musk. Well, that's not a trading strategy. Well, the price looked like it was going up. Well, why did you think it was going up? Like those are things you have to push on yourself to really understand, and then you can start to create a strategy, because everybody's strategy is different. Everybody will trade differently. Everybody will come up with many different things. But I always tell people I knew a trader that traded on nothing but moon patterns, and he made money. And so like as odd as that sounds, like he explained some things to me about it where now I'm not as skeptical as I get older and think about it. But at the time that sounded so fucking crazy to me that you could actually make money just studying moon patterns of people's behavior and moon patterns. But like my main point in this is that there are many ways to make money in this market. It's the reason why like you don't see like people who are actually good at trading going around and like commenting on somebody else's thing. This is why you're wrong, or this is why you're right, or I agree with this, or I don't agree with this, or you're stupid, or you're an idiot. Like real good traders who are actually good at trading understand that there's going to be some people who trade like this and make money, some people who trade like that and make money. And it's all really like you kind of coming into your own as a person and as a trader, and really identifying like the trader, where do you find your edge? I have a friend who tells me all the time about semiconductors and how bad of a trade it is, that I've been long it for the last few months, and it's a stupid trade, and I can't believe it's going to fall on its face and it's going to correct. It like basically tells me it's going to crash every day. And I'm just like, well, I, as much as I respect your opinion and he's a smart guy and he can absolutely be right, for my trading and my strategy, what you're talking about doesn't even matter. Like if it's going up and I don't know why it's going up, that doesn't mean anything to me. I don't lose money in my portfolio because it's like, well, they don't know why it's going up, Jason, so you have to give back some of these returns. It's not true. And it's the same way as like, if it does reverse course, I will either get a sell signal or my stop will come in and it's well into profit, way past the stop at the moment. So what does it matter? And it doesn't, and and maybe that style will work for somebody else, maybe somebody has the time. I've done it and I've played that strategy before when I was much younger, and it was very hard to say, okay, well, you know what? I don't think Nvidia should be up here. I'm therefore going to short the shit out of it, and I'm gonna wait for like a year, and it's going when it comes back, I'm gonna make everything. All I've ever gotten from that was a lot of headaches and a lot of losses. And
Yeah, it
so
sounds like a recipe for heartburn.
yeah, and it's just, for me, it's why fight the trend? Because I honestly, it's not just one, it's I have everybody always is against me about any trend I'm in, like the whole time I'm in it, and you've known me for a while, like, I will hang on to something until it really, really changes. Like there could be a massive sell-off, and I'm like, oh, that's not a big sell. To me, it's not a big sell-off. To other people, it would be, but to me, it's still not. And so, being able to hang on to something like Bitcoin as it's making its big run, or oil as it makes a big run, or lumber as it makes a big run, or any of these things, there's going to be a lot of like hard days in the interim. But once again, the whole time I hold on to a trade like that, I get people who hit me up, and this is not one person, this is numerous people who tell me that, oh man, this is going to crash, dude, this is going to crash. And it's like, oh, be careful, I get be careful all the time. And it's like, wait a minute, like, be careful betting against trends. Like, be careful, like, I've never lost, like, blown up by going with a trend. I've never have, like, that's not something that, ever since I basically stopped fighting trends altogether, I've had good years. All the years that I was fighting trends, I didn't have good years. So I know for a fact that there's two different things. There's one thing that works for me, and maybe other people can do that. I don't know how you fight against a trend to make money, but maybe other people can do that. But for me, I don't know how to do it. I don't speak on it because I don't understand it. And it's just not what I do. It's the same as I get all the same type of thing about just about everything. And what I always kind of think about is that, like, if somebody hates technicals, don't talk to me about technicals. Like, don't bring up that technicals. If you don't like relative strength, don't bring it up. Don't talk on it. Like, and there's tons of people on Twitter who go around and like try to disprove technical analysis or disprove
Yeah.
fundamental analysis. And they're people who are biased and obviously hate those things. And that's fine, but don't go, like, there's no reason to take, why are you taking the time out of your day to like tell people how stupid they are for using these? Like, especially, and the other thing, just to end it on something that's important for people to understand, the traders that I see really succeed, that have great returns year after year, are the people who could look at somebody that has a complete opposite style of them, and if they have these good returns or a track record, or they've been in the business for a long time, they will go, damn, how do you do that? Like, why are they looking at it that way? They're not going to sit there and say, look how stupid this is. They're going to say, how does that work? How does he do that? And they're going to try to figure it out, or back test it. Maybe they find out it's nonsense. Maybe they find out it's great. But either way, you learned something. You don't learn anything by just telling people they're stupid.
I love that. And it kind of brings me back to a saying, and I say this out of jest because I'm a technical guy too. But
Yeah.
I've heard it said that technical analysis is astrology for gamblers.
Yeah. Yes. Yes.
And I can see some people that use it that way, and no disrespect to the
Oh, there
Elliott
are.
wave folks, but
There are.
Elliott wave, you can draw anything on any chart and make it whatever wave you want, and then once it changes, it becomes something else, and you're never wrong. But for like objective, but for objective charting, like there's just it's either this or it's not. Like if you're
Yeah.
using Ichimoku cloud, it's either in an uptrend or it's neutral or it's in a downtrend. Very cut and dry. If you're
Yeah.
using like the EMA 8 as your short-term momentum indicator, above it you're got positive momentum. Below it, you've got, negative momentum. It's all these different things. It's like relative strength, relative weakness. When you look at it on a chart, it's either strong, weak, or neither. Like there's no
Yeah.
like room for misinterpretation when we're doing these things. And I think for technicals, there's two ways to look at it. There's the art way, where you get real creative and you make the chart do whatever you want. You're like the Pablo Picasso of charting, right? Or,
Yeah.
or there's the scientific way. And that's the way that Jason and I try to approach it. And so for folks out there that are skeptical of the value of technical analysis or of back testing or of systematic trading, look towards the people that are doing it successfully, that have polished systems, that make money doing this, and you'll find that they're doing it like an engineer. It's very scientific, it's very disciplined, and that's what creates that consistency. If you go to the other side and you look at the folks that are just trying to have the charts comport with their bias and support it regardless of what's actually happening, that's where you get in trouble, and that's where some of the hate comes from. But ultimately, we get paid by being objective and being willing to execute on that objectivity. And that's why some of these trades work so well when everyone hates them. Because if everyone loves them, who's left to get long? Like if everyone loves semiconductors, who's left to buy? And that's why some of these trades work so well. And it's counterintuitive. I mean, you can look at it from a fundamental basis and say, well, crap. I mean, NVIDIA's core business is decelerating. They're gaming, their data centers. It's a lot of AI hoopla, and that's fine. People are buying because of AI hoopla. The price is going up. Now, our goal in the market isn't to necessarily just sit there and be like, well, it doesn't make sense, so I'm not buying it. Like, it doesn't need to make sense. It needs to make money.
Yes, yes, absolutely, and that's well said. And it's just the thing that I think so many people come into. Relative strength's an interesting one too, because there's so many ways of looking at it. And like, for me, it's the first study I ever found, which was Meb Faber's on it, sector rotation strategy. And basically what it does is if the S&P itself is above a 10 day simple moving average, which it is now, you buy the top 4 sectors in the market, and then you hold them for a month. And if that changes, and it's the top 4 sectors over a 6-month time span. And so if you can find that and you can buy those and you can hold those until that changes, you look at the strategy once a month, you change it on the first of the month. This strategy outperforms fucking everything basically in the stock market, everything, very easily. And I still have people. I mean, I just put out the videos the other day, and I had so many questions about relative strength and how like dumb it is and this and that. And it's like, and like somebody asked me like, well, what's I forget, I don't even remember who asked this, but somebody asked me like, well, why don't you, if you look at the NASDAQ as having more relative strength than the S&P, why wouldn't you look at it as the S&P can go down because the NASDAQ is stronger than the S&P? And I was like, well, that would be the opposite of what actually happens in backtesting. 2, it's the opposite reason you would even use relative strength, because the point is to look at it and go, okay, this is like this, and you're basically trying to test it against whatever market it's against, in the NASDAQ being against the US market, so it's outperforming the S&P 500. But also you can take it into many different aspects and there's no such thing as a dumb question, so I'm not making fun of the question. I'm trying to explain how this works. So if you even go, okay, well, I don't like that because the S&P is too tech ridden, so you could you want to back test it against the world index, fine. You want to back test it against the Russell, fine. But also when I start to pick things like that, it's because I'm finding that it's not only the stronger than the S&P, it is stronger than the Russell, it's stronger than the world index, it's stronger than this, that, and the other thing. And then you can kind of come in and go, okay, well, that's why I'm going to take this. This is why relative strength works. This is what it does. And so you put your strategies together, and especially as a long-term trader, that's how it works. But, another thing, we're talking about this earlier, which is a cool subject because it's on the same topic, but a little bit different, because we talked about time frames and relative strength. And I was talking about, I have a vision that the NASDAQ is going to be the outperformer over probably, a few months to 6 months. And you are looking at it the opposite way, as the Dow outperforming the Nasdaq and using a spread trade to express that, but it's in a more shorter term time frame. So can
Yes.
you explain that trade a little bit? Because that's a very interesting way to look at two different ideas we kind of have here and how they both could work.
Yeah, absolutely. And so one of the things that I've been looking at and kind of keeping track of here is just the sort of crazy performance in the NASDAQ in the first quarter, up 20%, the biggest fundamental gap between the S&P and the NASDAQ in really a very, very long time, with the NASDAQ trading at a premium over 35%, huge inflows into infotech, software stocks, pretty much the entire NASDAQ ecosystem at levels we haven't seen since 2021, and led by the AI driven narrative that, a lot of this stuff is just kind of getting marked up over and over based on AI. And so that was part of coloring it, just kind of getting me into the sense of I should probably look at this a little more. Then looking at Dow, NASDAQ relative strength, and just kind of pulling back a chart over a couple of years and saying, well, you know what? The last couple times we traded around this level, we got a mean reversion pop. And so I'm not long-term bullish on the blue chip 30 versus the Nasdaq, but short-term, I'm just looking for a little mean reversion because I think the Nasdaq got a bit ahead of itself in the first quarter, giving basically 2 years worth of gains in 3 months. It got a little lopsided in positioning, and then from a relative strength ratio chart, we're just kind of coming back to a level we've been testing over the last year, and we can see this level has played out actually even going back to 2021. Back then it was resistance. Now it's sort of become support. That is to say, for the Dow to sort of rally here. And one of the things, if we look at this chart going back to just December of 2021, is also there was incredible relative strength for the Dow, for that period of time. It sort of outperformed the Nasdaq from December of 2021, let's call it through January of 2023, by about 50%. And so I just feel like we've got a little bit of a room for a reflexive bounce, a little bit of a rebalancing. The other catalyst I was looking at here is I'm a little bearish of long bonds. I'm not very bearish. I just think they're a little expensive here. I think they've run really hot. They're in a key area of resistance. They keep kind of getting sold down there. And that usually is not good. When long duration debt appreciates in yield and depreciates in value, it typically hurts the tech stocks, particularly the ones that aren't making a lot of money. So that was kind of the basis of the trade, but putting it on a short time horizon, because I'm not saying the NASDAQ's, this is like the second new bull market after our bear market that we've had. This is like the second time it's risen from trough to peak over 20%. I'm not saying that it can't have the chance to move higher. I'm just saying in the short term, I think there's a little room for an arbitrage here, a valuation arbitrage. The Dow is quite a bit cheaper. And in this environment of rising rates, tightening liquidity, and slowing business conditions, those type of stocks might do well as we rebalance. And then, of course, final thing, the end of the quarter, going into that period, we had just a lot of different people trying to do a little window dressing, saying, well, shoot, I didn't have any exposure to any of this stuff. It's going to look a lot better to our investors if we just kind of pretend we were holding it the whole quarter. So let's get some NVIDIA. Let's get some AI stock. What do they do? It doesn't matter. We'll put it on our sheet there. And we had a very interesting period of time in the NASDAQ as well, going into March OPEX, where there was just so much put heavy skew. So it was creating this passive bid, and that's kind of behind us now. So it's just a convergence of all that stuff. And me saying, I'll take a stab at it. My risk is very defined. My reward seems decent. Why not put this on and see if it comports to my expectations in my system?
Yes, absolutely. And that's why I wanted to cover that, because it's in a time horizon like mine, if I'm looking at a trend, like just think of any trend in any market, like a trend moving up, comes down a little bit, retraces, 30-50% of the move, whatever, 10%, and then moves back up. See, when you're looking at that on my time horizon, like that's something that I'm going to hang on to, that type of a trade. That little pullback is just normal. In a different time horizon, that trades like that can make your year. So, you have to really understand there's two different ones. It's kind of like something that I was always told to me when I started was about newsletter writers. And it's like, yeah, if you have a great newsletter writer and they basically don't fit your time frame, you could think they're an idiot.
Yeah.
But, you know, for example, if I'm out here and I'm going like, yeah, like I think long bonds, the Nasdaq, gold, you know, and some of these commodities could be a great trade. And that basically, and you're like a trader is trading in like a 2 week time frame or a 1 week time frame, I could be an idiot to you, you know, I could be completely wrong to you. But you know, somebody who's going, and then also there's the other people who just like constantly come back and are like, yeah, well, you know, I said, like, you know, they came out in 2018 and started calling, you know, for oil to go to 100, and then in 2022 they're like, look, it hit 100, I was right the whole time. Like, you know, like there's people like that. I'm not talking about those type of people. I'm just talking about people in general. Like you want everything to link up, and most importantly, if you have to understand a trader's time frame. If you're sitting there and you're fighting back and forth with somebody online, one, you're taking too much time out of your own life to do that. You should probably stop. But two is, if you don't understand their time frame, you don't understand what they're doing. So it doesn't matter like whether you think they're right or wrong. And once again, it's why like most people who have been trading for a while, they're not going to engage with you. A lot of people just block other people. Not saying that's right or wrong, just saying like there's no point for someone to sit there and argue with you every day about what you feel is right for your trading strategy. They're doing what's right for their trading strategy.
Yeah, I think that's a really, really good point. I mean, there's a lot of discourse and debate about, oh, this is right, this is wrong. But you know, here we are. We both have sort of separate sides of this trade, and we're both right because we have different time horizons. And I think that's the most important part of this. When you get the opportunity, everyone out there in the audience listening, to talk to other traders, the biggest takeaway that you have is that they are trading what works for them, their system, their time horizon, their risk management. And so it might not make sense to you. It doesn't mean they're wrong. In fact, if anything, when someone disagrees or at least has a different view, it's important to take that into consideration. What are they doing? Why are they doing it? And how might I be able to learn and benefit from that to expand my own horizons? Because trading, investing, finance, economics, it's a never ending journey of learning. If you think that's not true, you're doing it wrong.
Yes, exactly. And I just feel like it's such a major thing now when in the trading community that everybody has to because of social media really, you know, like you feel like you have to get your ideas out there and you feel like you have to push it on other people and argue it, and it's like I really believe like one, it's good to have an open mind. And so like, you know, listen more than you speak. If you can listen more than you speak, you're going to learn a lot about traders and other traders and so on. But if you're able to come into it with this open mind and learn from everybody else around you, you're going to have a huge lead on everybody else. There's so many people who like they live for getting online and telling people, like you could say like, hey, like, you know, look at Bitcoin, for example. Nobody will tell me that like, oh, I'm long Bitcoin still. I like Bitcoin. Bitcoin's cool. What they're going to say is, yeah, 1900 bought it. You know, like, or 1800 bought it, you know, like trying to talk about, you know, they're buying the low. And 90%, like once again, like I don't have their, you know, audits. I don't know if they're being for real or not, you know, like it doesn't matter. So it's like, okay, so when we're looking at this from a big angle, we're mainly just saying here, you know, be open to different strategies, different time frames, be open to not hating or talking shit to people that you don't really understand what they're doing, and also have a sense of respect. Like it's a thing of respect to just respect other people for their strategies and what they're doing with their strategies and so on. That's a thing of understanding that, hey, I'm not perfect. Like there is no trader out there who gets every fucking trade right, and there's always someone I feel like I can learn something from. So you know, on that we could jump right into this dollar situation.
Yeah, yeah, I
So
think it's interesting.
we have the dollar. Everybody has an opinion right now. You know, people at the grocery store to I got dog food the other day. Wherever it is, somebody has an opinion on the dollar. And it's going to zero. It's definitely going to zero. There's nothing that's not even gonna hit anything. It's just we're gonna wake up one day, it'll be at a zero. And some dude in Kenya talked about it, therefore, you know, it's gonna happen for sure. And the one thing I keep coming into and trying to have this conversation about was like, do you think that's the first time that this has happened? Like, do you really believe that this is the first time that some obscure country's president said, "Hey, get out of dollars." Like this happens all the time. Like I've seen this happen so many times. Not I think Turkey just did it last year or 2 years ago. Like everybody says this at some time. We got a lot of people pissed off at us. And I'm not saying I'm bullish or bearish on the dollar. I'm just saying getting to this point where it's going to zero is kind of insane. And not to mention, and even if and people talked about, us going off the world's reserve currency. Well, that's also possible, but did Great Britain's currency go to zero and disappear after that? Like, what exactly happened in those situations? We have this history to at least go off of. So, what do we really think will happen? How it's going to happen is probably all speculation. Nobody probably knows exactly how it'll go down. Who knows? It could go off of it and dollar could shoot up to the moon. Like, I don't exactly know. But what I do know is that most things, when everybody is saying they're going to go to zero, usually do not hit zero. And not to mention, we're not going to most likely wake up one day and it'll be at zero. And then we'll all go, oh crap, all our dollars are worthless and we're going to die.
Yeah, I find it all really peculiar because, look, I mean, I understand that a stock can go to zero. That there's some degree of probability a poorly run company can go to zero. I understand a bond of an insolvent company can go to zero, but there are things that don't really go to zero the majority of the time, and currencies and commodities, and of course, high quality sovereign debt. Those are among them, and yet there's this prevalent theme here: the dollar's going to die. Now, let's pretend we're walking into a neighborhood that's a little dilapidated, let's call it, right? And
Mhm.
you've got the yen, and it's a house that's just like burnt down to the ground. It's smoldering ash, right? And so we're like, probably don't want to go to that house. And then you've got the euro, and like its roof is broken, and the floors are caving in, the paint's peeling away, and there's termites, and you're like, yeah, it's cheap, but it's going to cost too much to repair. I don't want anything to do with it. And then you've got the dollar, and the house isn't in great shape. It needs new windows. It needs new shingles. It needs some, work done on the interior, whatever. But it's the best house in a terrible neighborhood. And that's the metaphor when we look at where we are with the major other currencies out there, like the dollar is 60%, the euro is 30%, the yen's just over 5% of global trade, of global exchange reserves. And I think it's really important to look at it from that context. A currency that has over $100 trillion of global debt priced in it, that has the most attractive assets, you buy them in dollars, where there's so much transactional activity happening there. This is something that, without some sort of catastrophic event, it's going to take decades for any kind of meaningful unwind to happen. And so people hang their hat on things like, well, Brazil and China just set up a bilateral trade agreement, and therefore, they're killing the dollar. Or OPEC just raised, they're raising the price of oil, and they're doing some trade with China in their currency. It's like, okay, like, reality check. First of all, bilateral trade agreements outside of the dollar have been building up for 20 years. Nothing
Yeah.
new there. And over the same period of time, the dollar's gone up, not down. Right.
Yeah.
And then on the other side of it, who does Saudi peg their currency again to?
Yeah.
Oh, right, the dollar. And all these other major oil producers, like the United Arab Emirates, the dollar. Like, this idea that everyone's going to move away from the best bad shirt in the bunch of shirts that are really bad, it's just not that likely. And so I like to look at this hyperbole as a sign, because what I've seen play out over and over again, and we've been trading this market for a long time. When this trope gets marched out, it's to pump the price of gold. It's to get people interested in euros. It's to try to reduce the standing of the US in the world. It's classic sort of sensationalism, pumping, and propaganda. And when we see it reach this level of fervor, it's an opportunity. I mean, the dollar is in a 12-year structural uptrend. Can it pull back more? Absolutely, it can. But if it does, I'm attracted to it. And the interim, I would say that if gold starts to get rejected here and starts to reverse lower at a level that's been resistance for, really going back in some ways, if you take it all the way back to like 2011, but at the very least over the last 2 years or so, I would be tempted to fade that because I think everyone's irrationally exuberant about where gold's going to go. Similarly, when we look at the long bond, I say, you know what? If we are seeing this repricing of commodities, as you mentioned earlier, commodities are very strong. That doesn't suggest a recession's coming around the corner, particularly with the depth that bonds priced during this banking route. So that tells me maybe there's a fade opportunity in the long bond. All of this fear where we're not really seeing the immediate cause. Are things going to get harder over the next year? Sure. Are they going to get harder over the next week? Who knows? But if we're priced for that peak uncertainty in things like gold and long bonds, and we have the dollar getting routed a bit here, I just feel like there's opportunity. Another area of the market I don't mind fading is the Japanese yen, because unless and until their central bank stops creating infinite credit to buy their bond market, and this is crazy, the Japanese central bank owns 46% of Japanese debt. The Japanese government owns 55% of the Japanese central bank. And the Japanese government is running a 260% debt to GDP ratio. Where do I sign up to short more yen? I mean, from a macro perspective, as a long-term trade, it doesn't just look kind of bad on the charts. It also looks unsustainable. And if there's any currency that might take a big downward turn over the next 10 years or even over the next year, it's probably something more like that than the dollar, which to anyone that's looking at all these variables, that's moving a lot of money around, they're saying, you know what? I think I'd rather be in something where the rates are higher, where the economy is strong, where there's more transparency and accountability. Like if you say the Chinese yuan, which is the latest propaganda trope, this is going to be the new world reserve currency. How? We don't even set exchange rates on a market basis. There's no transparency in the government. Their financial system has a $60 trillion real estate bubble that could collapse at any moment. What makes me bullish on that currency? I can't even buy it if I want to.
Well said. I mean, it's to me, it's as a trader, it's always like, yes, the cycle at the moment kind of suggests that the dollar can pull back. And it's really easy to create huge theses around this as the dollar's pulling back. Oh, look, it's going to zero. See, it's in a downtrend. Just like when it was moving up recently, it was the same thing. It's moving up. It's going to move up forever. Commodities are going to zero. The Fed's never going to stop. Like it's just constant, the ability to just kind of fade those ideas. And it's not that you have to fade them as in like shorting an uptrend or buying a downtrend. It's that understanding that, the dollar for me, when we see the dollar where it's at kind of today, I see that there's a possibility that there is a trade, right now in these other currencies against the dollar. But once again, do I go in and go, okay, well, I love the dollar so much, I'm going to hold on to it forever? Or do I go, I hate the dollar so much that I'm going to short it forever? No, because both of those ideas are wrong. And there's that's a long and a short, that's both wrong, because it's not going to go down forever and it's not going to go up forever. But what it is going to do is going to give you a trend one way. It's going to give you a trend another way. It's going to, following your idea, your system, your program, your methodology, however you have to do it, you can catch some of these moves. And, right now I'm kind of seeing an environment over the next 6 months where it's like, okay, well, the dollar could be weaker here. But people get too excited about the same people who are like the dollar's going to zero. If I'm wrong here, and if it turns up against me, those same people would still continue to hold it short. And if I'm right here and it's going down and then it reverses trend after I've made a good trade, I'm going to just continue to hold it anyways because I believe it's going to go to zero. So this is why I'm saying both of these strategies are wrong. So you have to really be open to that idea of hey, both of these strategies can be wrong on the long and short side. What exactly is going to work for me in my trading today? And how do I set up my portfolio to do that? And that's going to put you, leaps and bounds ahead of everybody else in this market.
I love that. And I really think that's the biggest thing that for everyone that's listening to take this away. Never get married to any idea. Never. Never, it doesn't matter how right it seems. It doesn't matter if you've tied your ego to it, which by the way, you should never do, but just never get married to any idea. Because the thing about the markets is, as soon as you think you're 100% certain about anything and you're just going to carry it forever for whatever happens, they're going to humble you. Yeah, anytime you get too egocentric and just kind of get into this mindset that the market's wrong, I'm right, it doesn't matter if you're right. What matters is if you're making money. And the way you make money is you don't get married to things. You don't stay wrong for long. And this is one of the key points that I think a lot of people kind of miss. And I get folks out there that are kind of critical, like, oh, you're a perma bear. You've been wrong since XYZ. I mean, first and foremost, I don't try to call tops. It's not my goal. But on January 4th, I put out a YouTube saying this was the end of the bull market, January 4th, 2022. And it was because of the macro factors that were happening. And I was just saying, this is it. It doesn't mean that we're going to zero, but it means that crypto and growth stocks are going to get hit the hardest. And they went down 70% from there. And so the reason that I say that is, that was my long-term thesis. And it's still intact. But on the short term and the intermediate term, there's plenty of opportunities to trade long, short, and equities, and also just get into all different types of asset classes. And in this end cycle environment, here's one for folks out there to consider. In end cycle environments, one thing that tends to happen is low volatility large caps tend to outperform high beta large caps. And we're seeing some of that relative strength come back in, and we're seeing positioning rotate from cyclicals to defensives. And this is something that if we go back all the way to 2008, we can see every time there is either just a big burst of volatility, an increase in high yield spreads, this trade works, right? And we kind of have the basis for both of those things to potentially play out as the year goes on. It doesn't mean we're going to have a great financial crisis type of crash. It doesn't mean we're going to have another COVID situation play out. But this system has actually worked about 6 or 7 times during that time period. And only 2 were real bear markets. Anytime there's greater uncertainty in the market, this trade tends to work too, because you've got institutions who are running hundreds of billions of dollars. They can't move that all in a day. So it becomes a rotational trend, a relative strength and low vol, relative weakness and high beta. And, this is the type of trade that I like to put on because A, it helps to manage some risk, and B, it's based off what we're talking about here. This idea of, longing into strength, shorting into weakness, balancing out some of these trades based on that. And quite frankly, if we're talking about just full cycle investing and trading, it fits into that framework potentially as well. And so for folks out there that are listening, remember, whatever views Jason and I might be generous enough to share with the greater public, it doesn't reflect our entire trading book. It doesn't reflect our system. It might just be an off-the-cuff opinion, or it might be a time frame that doesn't comport to yours. I often get criticism that, oh, this isn't playing out. It's like I literally tweeted it 10 minutes ago. And this might be like a 6-month time horizon. Like, oh, that's not working out. They're bullish in the markets. Like today, ISM new orders came in really bad. And so, people are like, oh, that's bullish. The market's up on it. It's like, yeah, sure. But, there's this thing called earnings. And if there's less economic activity, they tend to not do well. So it might not happen today, but these are the warning signs, the cookie crumbs along the way in this earnings recession period that give us clues as to where there might be outsized weakness in industrials, materials, manufacturing in general. They're seeing some weakness, and that's going to matter because that could also impact where relative strength is in the future. And if we understand it from a macro fundamental basis, and then we see it in the charts, that plays into actionable trades. So did it play out in the 10 minutes since I tweeted it? I'm so sorry, it may not have. Maybe it took 20 minutes, right? But over the long term, this stuff matters. And this is why it's really important to have an open mind. When we approach trading every day, got to approach it with a blank slate. Trade the market that's in front of you, not what you want to see. And you can have your long-term analysis and you can have your opinions, but don't color everything with that. Be open to the idea that A, maybe it's been priced in already. B, maybe the market has a different idea altogether. And C, maybe there's participants out there that have more information and move more money than you may. And so for folks out there that are listening, be humble, be open, be a student. Never think of yourself as the master. The market will always be the master, and it will always have a new lesson to teach you. And it's your choice as to how much tuition you paid in that, in the form of losses.
Yes, absolutely. And that's so well said. that's the biggest thing that I think most people deal with, is that they just don't understand that difference in time frame, the difference in opinion, that or that someone, like, you could talk to someone and they could have this different view, and these people could be have some. I have I have people who send me things from dudes who've been trading for like 30, 40 years, and I know they have great returns, and I know they kick ass, and I'm like, well, why are you sending me this to make fun of this guy? Like, you don't do shit. Like, like, not trying to be an asshole, but it's like, compared to even me, that person is amazing. Like, and then compared to you, you just started trading 3 weeks ago and you're making fun of this guy. That doesn't exactly add up. So it's, I mean, I would get into this at the beginning. Like, you find so many people at the beginning of your financial journey that hate, like, Warren Buffett. And to this day, yes, I don't trade anything like Warren Buffett. I don't really use his style. I'm nothing like it, but I absolutely respect the shit out of the guy. Like, I can't say, like, that he's a bad investor. Like, I can't say any of those things. Like, that doesn't make sense. That would be idiotic of me to say that. The guy obviously has his shit together and he knows what he's doing very well. And also, it comes with unrealistic expectations. Most people, when they look at markets, they see it as this magical thing that can be, you're going to make so much money, 100% a year, 200% a year, 300% a year. And it's like, no, like, you're looking for like 20, 30. Like, if you hit 20 and 30, that's pretty good. But, like, let's talk about real numbers. If you run an actual fund and you've been doing the fund for many, many years, average numbers for funds are more like 10 to 20% a year. That's it. Like, so if you're a trader and you're basically, the main goal is to outperform the market. If you're not outperforming the market, you should just put your money in the S&P 500 or something and walk away. But if you're a trader and you're trying to outperform the market, you have to look at it as, okay, the market's, on average, under 10%, like, would be the average. So I got to beat that. Okay, and then once you beat that, then you can move on. But get those unrealistic expectations out of your head that you're going to be, the next Victor Sprandio and putting together a bunch of 100% years. Like, not everybody does that. Richard Dennis did that for a little while, but also he lost a lot of money at some point. Like, that's just how that happens. So you could be the person to go, I just want to be consistent, put together my 20, 30, even 10, whatever it is, percent a year, put this away over and over again, compound that together, 20% a year over 10 years. That's a lot of money. You've made
Yeah.
a great return. But most people, they're thinking in, like, I see that this guy over here bought Bitcoin when it was $1 and I didn't, and it's $20,000 today or something. So therefore, I would have made this much. So I need to find the next trade that's going to do that. And it's like, no, that's not it either. You're missing something.
And that's a really good point, though, because expectations are so important to consistency and discipline. I think a lot of the reason that people feel obligated to take every single trade that pops in their head is, oh, I just need to keep compounding, or, oh, I need to revenge trade myself out of this loss. But the reality is that that doesn't work. At first, if you have too many positions on and you're trying to manage them all at once, you're going to miss entries and exits, especially if you don't have them managed in a more systematic way. But the second is, if you think you're just going to start off, especially as a newer trader, and start compounding triple digit annual returns, you might get lucky. Like, a lot of people had that happen in 2020, and they're like, oh my God, I can just print money. And it's like,
I'm the
well,
best.
yeah, exactly. Like, you could literally throw a dart out and have a dartboard of like every stock in the S&P 500, and it didn't matter which one you threw it at. You were making money because there was literally a tsunami of central bank credit flooding the system. So everything had a bid, right? We went from like there is no alternative to like literally you have to buy stocks gun to head. Like, everyone
Yeah.
has to buy stocks. There's so much money floating around the financial system. And I think that's one of these extraordinary takeaways from where we were. Like, a lot of people, a lot of retail, I'm retail, you're retail, we're all retail listening to this for the most part, right? A lot of people join this market at a time where it was the easiest time in human history. And I don't even mean just like post-COVID crash. If we go from 2009 on, with the amount of central bank stimulus that greeted markets of all kinds, that was also an extraordinarily easy time because there was always a backstop. At the index level, you could always buy the dip and you'd come out even or ahead over a long enough time span. We're not exactly in that same environment anymore. And so the idea of being a hero and, playing this game of getting aggressively long with leverage, or going max long calls or whatever, it can hurt because you're not in the same environment. You're not in that, the Fed has a put right under you, so you're just going to be fine. There's a lot of confluent forces that add to the risk here. And so the idea of what used to work in terms of risk management, in terms of how we might trade, in terms of the level of awareness that we need to have in the market to really be successful, that's changed a lot. And it's not just for us folks that are home gamers. There's a lot of advisors and portfolio managers and risk managers that never really experienced a true recession or a bear market, that weren't in the game during the great financial crisis. And let's face the facts. What happened in 2018, late in the year, that sort of tightening tantrum we saw, that wasn't a real bear market. And what we saw during the COVID crash wasn't either, because it reacted and reversed so quickly as central banks just pointed a liquidity cannon at the market and just saturated it. That's typically not how these things go. They can grind out for years. They can at least grind out for many more months than people expect. And so having reasonable expectations of returns, awareness of the environment that we're in, the volatility regime, the liquidity regime, it's really important for us as traders and investors to be successful. So in the current environment, that's so much different than the last environment that we've been used to for the better part of 13 years, we have to do things a little differently. And that's fine. That's the opportunity to learn and to grow. So if you're out there and you're listening, you only started trading after COVID because you were locked at home and the world was ending, and yet there was all this stuff happening in the market. It was really exciting, and it was a really fun time. Remember that it's not that you're doing it wrong. It's that you're in a different regime now, and things are trading in a different way. Valuations are being looked at in a different way because we're no longer in a period of just abundance of liquidity and very cheap cost of capital, negative real rates, all these things that allow people to go further and further out on duration, on risk. Now we're in the opposite regime. And that means, maybe shorter duration has a better bid. Maybe companies that have, higher discounted cash flows tend to do better over the longer run. And that pushes us from the growth factor to the value factor. And the other thing is, for folks that are longer term, if you're just an investor, look at it from a different perspective. Factor performance. Who leads the bull market? If you see a bull market that's led by one factor, the next bull market probably won't be led by the same factor. Similar with sectors, right? Yep. And so maybe we start to see a rotation there too. And so just being cognizant of where we are in the cycle, what's leading, what's lagging, having reasonable expectations of your gains, coming up with systems, testing them, iterating them, improving them. That's how we can win. And that's one of the things that Jason and I love to educate on, because we don't want to just be successful traders. We want to learn to continue to amplify that success. And we want to share that knowledge with others so they can skip some of the pain we might have felt early on when we were cutting our teeth.
Absolutely. That's well said, and we'll end it on that because that's perfect. Because that's really, the goal of everything we do is really to, one, it's really fun to have these conversations because one, talking out our ideas and learning from each other is always super helpful. But two is, I'm very happy to share these ideas. I don't think for anybody there's no easy secret I could tell you to trade better. What I can tell you and try to teach you the most is how we build our own models, how we become ourselves in trading, and how we can do that in a way that fits our lifestyle and our stress levels. And everybody's going to be different in that. So, thanks for coming on, man. It's always an absolute blast to chat with you. I'm sure my listeners will absolutely love this because that's what I really like to focus on, man. Real trading, really what's going on. And how to do it and how to do it successfully.
Absolutely, Jason. Thank you so much for having me on, my friend. I really appreciate it. I love and enjoy our conversations. They're always illuminating. I hope everyone out there enjoys this one. I look forward to coming back. I'm happy to hop on and chat anytime, my friend.
Oh, absolutely. Absolutely coming back on. All right, man. Thanks.